So my role, ladies and gentlemen, basically is to take you through financial reporting, and then we have what we call management accounting. Management accounting. Remember, it doesn't matter whether you did management accounting as a specialization paper or not. No. Here, it is general duty because you don't know which paper whose question they shall be bringing here that is the easiest. You know, there are two compulsory questions in BDA. We have financial reporting and then we have financial management. These two are what here, they are compulsory. They are compulsory. And then, of course, the other areas like taxation, management accounting, we have auditing and assurance. Those are what here, optional questions. They'll give you optional questions. So what a good student does, just like last semester they gave us a regression analysis and the management accounting. So they don't look back to see whether you specialized in the paper or not. So long as you go there, do the compulsory questions here, and then of course the other question that you are going now to pick, you can pick from whichever subject, regardless of whether you specialized in it or not. Oh, I need to record this. I can see Gaki is putting up her hand. Gaki, would you want to talk to us? Ask to unmute Gaki. Gaki wants to talk to us. Let me also get to listen to a voice of a lady. Are you able to unmute yourself, Gaki? Gentlemen, you don't have space here. Gentlemen can't talk at all. No, I'm joking. So before we start, I think Mwebia aliweka mkono juu by mistake. So lower hand. So please, that is a very good way. That's a very good way of communicating. You simply put your hand up and then I'll be able to unmute you on the, and of course you have the other way of chatting, right? You should also get to chat. Now, so today, then I would want to take you guys through financial reporting. Financial reporting is the one that is a bit heavy. Unlike the others, financial reporting is a bit heavy. So under financial reporting, what happens? Under financial reporting, I was record. Look at this mzee now becoming old. We shall overcome. Very good. So, ladies and gentlemen, under financial reporting, just like last semester, this examiner is quite a tricky examiner. For the very first time, last semester, this examiner went ahead to give us a question from published accounts. So remember, under published accounts, if you can recall very well, your examiner will give you a trial balance, and then he'll give you notes to the accounts. He'll tell you, for example, there is this inventory that was bought some time back, whose cost was 200,000, but on remeasurement, on revaluation, they have discovered that the net realizable value is 150. The net realizable value is 150. So according to IAS2, which figure should we pick and place it on the face of our financial statements here as per the published accounts? Is it the cost of 200? Or in this case here, net realizable value? Remember, IAS2 talks about what here? IAS2 talks about, okay, IAS2 talks about what here, somebody? Yeah, the lower. In this case here, we shall take the lower of the two. So what does it mean? That now moving forward, given what these people here set last semester for BDA, they also expect students here to be very good in terms of what here? Standards. Because you see, published accounts is all about mastery of standards. We must know something to do with the IFRS 15, revenue with our contracted what here? Customers. We must know something to do with what here? IFRS 9, financial instruments. We must know something to do with IFRS 3, business combinations, IFRS 10, consolidated what here? Financial statements. The good thing is that we are around here to help you people. All right. So then my role today is to take you guys through, of course, this concept here. And I would want to start with consolidation. Mention there group accounts, group accounts. Are we ready? Are we ready? Are you able to see my board? Somebody's talking about zooming too much. Thank you, Dama. At least Dama is able to answer Abdi there. So I'm looking at business data analytics, BDA, all right? And I'm looking at group accounts. And a group accounts, of course, I'll be looking at IFRS 3 and IFRS 10. And of course, IAS 28, investments in associates and what here? Joint ventures. I'm not very good in terms of setting up my whiteboard, but are you able to see my whiteboard? Are you able to see my write-up? That is the most important thing. Because I can see somebody telling me they're able to see my reflection. Of course, I know I'm very black, but at least are you able to see my whiteboard? Are you able to see my whiteboard? Yes, that is the most important thing. Yes, that is the most important thing. All right. And then, of course, somebody may ask, Mwalimu, we are used to you teaching BDA in Excel 100%. Why are you bringing up this thing of a whiteboard? Why are you taking us, in this case here, backwards? All right. Now we are there, moved straight away to Excel 100%. And here now, Mwalimu, you are going mechanical. Is there somebody who is having those kind of wild thoughts? We shall overcome. We shall overcome. We shall overcome. Now, ladies and gentlemen, there are some topics here, like, for example, published accounts, some topics like group accounts. I will be forced to do them in two ways. I'll be forced, whenever it is convenient, I'll be writing on the board to give especially the background. But again, whenever it pleases me to do so, I'll be going to my Excel. The only thing you need to learn, you as a student, is that for you, you will not be writing by your hand. For you, it is 100% Excel. After all, am I going to do any exam? At the end of the day, am I going to do any exam? No. You guys are the ones who are going to write that exam in Excel. All right. Mine is to ensure that you get the principles, but I'll be doing this interchangeably. At times I'll be writing on the whiteboard, and at times I'll be doing this in Excel. But for you, it's 100% Excel, and I'll be requesting you guys to share your workings as we progress. Now, ladies and gentlemen, again, I'm not going to tell you so much about group consolidation. I'm not going to give you a lot of theory. Your group consolidation questions in your exams are very, very easy. What you're supposed to know is how to account for a subsidiary, how to account for what year an associate stroke what year joint venture stroke joint venture. And of course, we have the normal investments. Now, to help me is a question that I have here, ladies and gentlemen, which is what year? Mwalimu, write in Excel. I'm being reminded here, write in Excel. No, I'm not writing in Excel. I'm not writing in Excel. I'm not writing in Excel. So I have a very good question, ladies and gentlemen. Even short notes should be in Excel. Ah, hi, Celine. Great, we're overcoming. Great. So here we are, and I'm looking for this great stuff here. Is there anybody who does not have any background on group consolidation? Any background? No, you can't remember even a single thing in group consolidation. Do we have anybody? Do we have any kind of such kind of a ninja here? Do we have such kind of a ninja here? Who knows nothing regarding group consolidation? Who does not even remember that to consolidate is to put together? To consolidate is to put together. To consolidate is to put together. Who does not remember that at all? Nothing. Ah, Mercy is saying, aha, will be fine. Now is your time to talk. No, you don't need to worry whatsoever. Don't worry whatsoever. Now, ladies and gentlemen, when we talk of group accounts basically is also known as what here? Group consolidation. Is also known as group consolidation. Group consolidation. Under group consolidation, what are we required to remember? We are required to remember here that we have a company known as the parent company. A company known as the parent company, and another, or there could be more, other companies in this case are known as what are subsidiaries. So whenever we talk of group accounts, under group accounts, we are going to take the financial statements of the parent, financial statements of the parent, plus financial statements of what are the subsidiary companies. So whenever you talk of group accounting, you are taking the financial statements of the parent company plus financial statements of what your subsidiary companies. Subsidiary companies. FS stands for financial statements. Financial statements. Now, ladies and gentlemen, and this is the most important thing, if we are given here two companies here, company A stroke company B, how do we get to know that, for example, A is the parent of B? A is the parent of B. We always work with that parent subsidiary relationship using an aspect known as what here? Known as control. Known as control. Control. That you can only be said to be a parent of some kid there if you are able to control that kid. The moment in this case you're not able to control that kid, then you cease being what here? The parent to that kid. So in this case here, parenting is about control. So for our case, ladies and gentlemen, remember it is very, very easy. If I own more than 50% of the shares of a company, if I own more than 50% of the shares of a company, then that company becomes part of me. That company becomes my subsidiary. So if shares are more than 50%, so more than 50% of the shares, then that automatically company will be known as what here? Will be known as a subsidiary. I'll give you all those notes. Just try to understand. Don't be quick, or rather a writing machine. No, try to understand that if I own more than 50% of the shares of a particular company, then I'm able to control that company. Because more than 50% means what? That we're going to have like two parties. We have the controller, the one who has more than 50%, and then we have in this case here the controllee. Listen here, ladies and gentlemen, the one who has got more than 50%, I would want you to understand this from the word go, So we have two parties here. If, for example, we have, say, a good example, we have acquired, say, 60% of B, 60% of B. So it means that automatically this 60% is more than 50%. So then we are able to control B. If we own more than 50%, we are able to control B. So A becomes the controller, B is the controllee, the one that is being controlled. The controller will be known as what here? A parent company. So A becomes parent, A becomes the parent, and then of course B becomes what here? Part of the parent, because you're controlling it. Subsidiary. Now, please listen and listen to me very well. If we own 60% of B, then someone else in this case here must be owning the other percentage. So if we own 60% of B, we, the majority, ladies and gentlemen, automatically we shall be called the parent. And then we have the minority, the one who has this 40%, which name do we give to them? Of course, in this case here, we have another party who owns, in this case here, 40%. What name do we give to this minority shareholder? Minority shareholder. It is non-controlling interests. It is non-controlling interests. So, ladies and gentlemen, remember, it's all about control. Just like, for example, in the Kenyan politics, we know that Kenya Kwanza is the controlling interest. You know, they don't have to own like 100% of Kenya. No, they never in this case here got like 100% of the votes. It is 50% plus one, which gave them the mandate now to control all parts of the country. So in this case here in parliament, these guys are the controlling. And then now we have Azimio, who is who? Who is the non-controlling interest. Wako mpaka na chief whip wao. Minority whip like that. So the most important thing is that for you to be able to control, what you need is 50% plus what here plus one. More than 50% of the shares. More than 50% of the shares. I like some comments I see there. Somebody is telling me that Mwalimu, that example is irrelevant. You come and give us your relevant examples here. It's about control. And the control is what here? More than 50% shareholding, more than 50%. It's called force versus habitol. The principle of what here, majority. The majority will always have their way. Of course, minority will have your say. But at the end of the day, it's about who is going to have the last walk on the aisle, the way. It is the parent company. It is the parent company. But again, as I go back to my Excel then, which you guys would want me to demonstrate here, there are things I would want to hear from you. Assuming, how many of us are we here in Zoom? In Zoom, we are 215. 215, in this case here, millionaires. Assuming each one of us was to make a contribution of 10 million Kenya shillings, if each one of us in this case here makes a contribution of 10 million Kenya shillings, how many billions shall we be having at the end of the day? Some mathematician. If each one of us was to contribute today 10 million Kenya shillings, 215 times 10 million, how many billions are we talking about here, somebody? How many billions are we talking about here, mathematicians? 10 million. Each one of us times 215. So Dama, in this case here and the rest, they are telling me that Mwalimu, we shall be able to raise 2.15 billion. 2.15 billion. Now, ladies and gentlemen, with 2.15 billion, I believe we can easily go to Nairobi Hospital and we buy. I don't know their market valuation today, but I believe we can go there and buy, like say 70% of Nairobi Hospital. So we buy. So we'll call ourselves the Accountants Club or the RCM Club. So the RCM Club, Accountants Club, in this case here goes and buys 80% of Nairobi Hospital. Nairobi Hospital like that. But let me ask you a question. Do you think we have the capacity ourselves in this case here to go and sit in the board of Nairobi Hospital like accountants, all of us, and run this hospital effectively? Do you think we have that capacity? Do we think we have that capacity? No, we don't have in this case here the skills and competence to run what here a hospital. So it means that this other guy will be having the minority, perhaps some 5 doctors over there. Some 5 doctors over there, they could keep themselves together and then they buy the 20%. And once they buy this 20%, of course, ladies and gentlemen, in this case here, these guys will be the minority because they have a minority stake. They have the short end of the stick. When we are holding this stick, somebody will be having a short end, another one will be having a long end. So the accountants have a long end, then they have a short end of this stick. But now, if we sit down as accountants and we say for sure, we can't run this hospital, let's give the mandate of running this hospital to these doctors who have 20%. So they run the hospital on our behalf. So between the doctors then and we accountants here who have 80%, these are the guys who have got 20%. But we have sat down in an AGM and we said, as what we would want are dividends at the end of the year. Please, doctors, go and run the hospital. And we will not even interfere with anything. Go and run that hospital. So truth be told, who will be controlling this hospital? Is it the doctors or is it we, the accountants? We'll be controlling. Will be controlling. It will be the doctors. It will be the doctors. And in that case, it is the doctors who will be required to consolidate. So this hospital becomes a subsidiary of those doctors. Their smaller percentage, notwithstanding. Their smaller percentage, notwithstanding. And that is why IFRS 10 tells us that it has now moved from the game of percentages. It is no longer about shareholding. You could be having just 10%, but by courtesy of some agreement, in this case here, still with that 10%, you will be said to be the controller. You are the parent because of some form of what here agreement, some form of agreement. And I remember some time back, they gave us this kind of a question. Please listen to me. Please listen to me. Listen to me very well. You know, we have got various categories of investments. Assuming in this case here, you have these here kind of shares. If you have more than 50% of a company, then this company of yours will be called a subsidiary. More than 50% will be called a subsidiary. If you have exactly 50%, then this one here will be called a joint venture. And then, ladies and gentlemen, if you remember, between 20, more than 20%, but less than 50%, this one is normally given a special name. Is there somebody who is able to remember this special name? It's an associate, yes. So this one here automatically becomes who? Becomes your associate. This becomes your associate. And then, of course, we have our mere investments or financial instruments if it's below 20%. I remember, and this is a paper that some of you did this paper sometime back in Advanced Financial Reporting. Please listen. This is the paper that you did. There is this question that made some of you to get a big fail. They told you something very nice, that A and C own, in this case here, a company called B. So A has 50% of B, and then C has 50% of who? Has 50% of B. For sure. This is Mr. 50-50. It's exactly Mr. 50%. And if it's Mr. 50%, then automatically under IAS 8, we are supposed to account for B. We as A are supposed to account for B as a joint venture. And remember the standard which was tweaked here. If it's a joint venture, we shall always account for it as what here? As an associate. That's why we have one standard called IAS 28, accounting for associates and who? Joint ventures. Now, ladies and gentlemen, remember, we only consolidate. I would want to be very clear from the beginning. We only consolidate a parent and their own children. Consolidation is for parent and the subsidiaries. Please listen. I would want to be very, very clear here. So assuming here, you have got 3 columns. Assuming here, you've got 3 columns. 3 columns. Which columns are these? Don't write these notes. I'll give you notes. So assuming you've got 3 columns. So we have a parent company. We have a subsidiary here, and we have an associate here. So these guys have given us revenue. They have given us revenue. Revenue here is 100, associate is 20, or rather subsidiary is 20, associate is 10. We have cost of sales. Here we have 80, here we have 15, here we have 3. And then now here, I would want to come up with a group here. Don't write this. I would want to come up with a group. So then how do I come up with a group? Remember, assuming that we stayed with this subsidiary for a whole year, whenever it comes to group consolidation, we take parent financial statements plus subsidiaries financial statements. We don't incorporate associates. We don't incorporate joint ventures. So basically joint ventures and associates, these ones here, you will have to strike them off. So in my group consolidation, this is just a hypothetical example, a very short example, just for illustration purposes only. So in this case here for revenue, I will take 100 plus the subsidiary, which is what there, which is 20. I cannot bring in a figure of what here? Associate. The same case in this case here with cost of sales. I will only take the cost of sales of the parent plus cost of sales of what are the subsidy, cost of sales of the subsidiary. We can't bring in figures of the associate. We can't bring in figures of the associate. We only consolidate the parent and who and the subsidiaries only. That's what IFRS 10 tells us. For the associates, we shall only use what we call equity accounting. And I'll be teaching you what we call equity accounting. You'll have to do their mathematics separately, and then you bring their answers as one line item in the statement of comprehensive incomes, and of course in the statement of what year financial position. Only one line called investment in associate. All right, investment in associate, investment in joint ventures. But for subsidiary and the parent companies, it shall be a combination of one to one. So in this particular sitting, they went ahead and gave us very good information here. So we had in this case here information about a joint venture, here, a joint venture, because we have in this case here 50%. We have 50% of that company B. So they gave us information. But now there is one point, and at times CASNEB is very, very unfair. They really make my students in this case here to mark time around here with short, highly English worded statements. So in this case here, they went ahead and told us, fine, A owns 50% of B with a company called C, which also has 50% of B. And then they went ahead and told us that C has removed itself 100% from the management of B. They have relinquished their powers to manage B to A. So in this case, it is only A who can do what here, who can run the affairs of B. It's only A who can run the affairs of B. Now, the question that I want to throw to you tonight is this. If you were a candidate in that particular sitting, how would have you accounted for B? Would have you accounted for B as a joint venture and struck it off here while you're consolidating? Or would you have, in this case here, handled it as a subsidiary and they included the figures in the consolidated financial statements? Please, the ball is on your court. The ball is on your court. It is a subsidiary. You guys are very, very bright. Because nowadays, it's all about what? It's all about control. So long as it doesn't matter what percentage of shareholding they give you, so long as you hear that there is a concept of what here, control being thrown on your way. Like now, another semester, they asked our students this kind of a question. These guys are bright. But I can assure you, this semester, because they'll bring us a group consolidation question, we shall be brighter than them. We shall be brighter than them. We shall be brighter than them. And that is why, especially for AFR or even BDA, after your exams, when you call me after exams, like students who normally call me, they call me and they tell me, Mwalimu, let us get down and have some cup of coffee. I love coffee myself so much. Let's sip some coffee somewhere. Please, when you are in that exam, or rather that area, taking our great coffee, right? Don't be talking about like this exam was very easy. This exam, I'm going to knock 105 out of 100. No. When the deal is too good for CASNEB, you shall always, that statement is highly applicable with CASNEB exams. When the deal is too good, always think twice. So this examiner tested students like this. He told these students here that we have company A, which owns 40% of B, right? So meaning that for sure, there must be another stakeholder who has 60%, who now has the majority stake, who should be consolidating. But now this clever guy went ahead and told us that the 60% in this case here is held by 100 shareholders equally. 100 shareholders equally. I'm telling you, so many students in this case here did not understand the essence of this. So many of them. And so many of them called me after exams. Mwalimu, I knew that B straight away was an associate. Mwalimu, I'm going to pass this exam. When these exams come, results come, they come like this. Just like most of you in BD last semester. Most of you when exams came, they came like this, despite the paper having been very good. And you kept on complaining it's about casting them, it's about casting them. Of course, yes. But at times, ladies and gentlemen, there are those subtle statements which are in those questions which can make you, in this case, slide down. So we have to be very, very careful. You see, like if 60% is held by 100 shareholders, it means that each of these shareholders here has 0.6%, each of them. And then there is one guy who is you, who is A, who has just 40% on your own. What do you think of that arrangement here? How would you account for B, despite having 40%? Despite having 40%, how would you account for B? Please be very serious. Please be very serious. How would you account for B? 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 Now, they're not talking to me. You see, for B, there is A who has 40%, and then all the other shareholders, they have what? In Germany language, would have called an ochugunu. Very small, 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 small. Very tiny, tiny insects. Very small shareholding. All right. So again, there you are the king of the jungle. You're the king with 40%. You are the one, in this case, you will be able to have a bigger say in the AGM. So that signifies what here? Control. That signifies control. That signifies what we call control. And that is why we shall be defining control using what we call the pair principle. Using what we call the pair principle. Pair principle. Pair principle. Pair principle. So under pair principle, this is how they define control under pair principle. Under pair principle, control is pair. Is pair. Is pair. So is there somebody who is able to remember this, the meaning of this acronym? Pair. Pair. So P stands for power. That you are powerful in this entire organization. You are powerful. You have, for example, the majority shareholding, things like that. You are powerful, even with 40%. In comparison to the others, they can't speak before you. You'll be able to appoint most of the directors of the company. So in this case here, P stands for power. All right. P stands for power. All right. And then we have this A standing for what here? Exposure. Exposure to variable returns. That it doesn't matter how small or how big your shareholding is, but at least you must be having some stake of the ordinary shares. Don't come and tell me that I am a debenture holder, I'm very powerful, that I can even close the company, and then you tell me that now I want to consolidate. No. If you're just a debenture holder, you don't have shares. You must be having some share, even if it's 10%. You are powerful, fine. But if you don't have any shares, then you can't consolidate. So you must be exposed to variable returns. And then, of course, A stands for ability to use the power, to use your power to increase the returns of the company. The returns of the company. Pair principle. You know, ladies and gentlemen, if you don't have any shareholding, then you will not be having any reason why you would want to work so hard for profits of the company to increase. Because if you are, for example, a big debenture holder, it means that you are not interested in profits, because whether profits are generated or not, you will still earn your interest. So you must be having some shareholding. But the most important thing is that you must be what here? You must be powerful. You must be powerful. Now, with that humble introduction, are we now ready to face a question? I give you a simple now illustration, we do a question. Are we ready for a question? Are we ready for a question? Great. So remember, it's all about control. Even in marriage, these spouses, there must be a parent and a subsidiary in marriage. So it depends on who is able to control the other. So if, for example, you are a man, and of course we know men, here we are, and we should never deny this. If you're that type of a man, whenever in this case your wife tells you to jump, you only ask her, how high do you want me to go? So even if you're a short like Mwalimu here, how high do you want me to go? If she points at the ceiling board, you jump like that, then automatically you are the subsidiary. And it's important for you to recognize your position in the family setup. It's about who has the power. And is she exposed in this case here to these variable returns? Like when you get your salary, is she able to get like a bigger percentage? Does she have the ability to influence the return she gets from you? It's called the pair principle. It's called the pair principle. We shall overcome. All right, now we are ready. That's a very good one. Somebody is inboxing me here that Mwalimu, hata mimi nimefinya kajamaa kamoja. Please release. Don't control that man that way. Release. But I mean, we also don't care. So long as it works for the family and you are able to grow as a family, we also don't care. I mean, that's life. Usikatoke hapo ukiwa kajamaa useme sasa leo naenda kumwambia hata mwalimu amekataa. Hakuna kukaliwa chapati, hakuna we. Ndoa itavunjika. Tutaki ndoa ivunjike. We shall overcome. The voice iko chini. Is that the case? And the way I'm really shouting, and the way I'm shouting, are you able to hear Mwalimu? We shall overcome. Iko sawa. I think ni nini yake. So this is the question that I have, and I would want to share this link with you right away. Control C. So for the students who are in Zoom, I've been able to send the link there. The link to the question that I'm doing, the link to the notes. So please take it, and if possible, send it to our WhatsApp paid group. And this is the question that I'm doing here. Great question, really. Great question. It's called Marina Bay, Singapore and Marina Bay, two companies. On 1st January 2011, Singapore company paid $90,000 for a controlling interest of 80% in Marina Bay company. So ladies and gentlemen, what they're telling us is that we have acquired a controlling interest already. They're defining for us. They're telling us that now we have a controlling interest. If we have a controlling interest, si ndio wenye kusema. Singapore tumekalia wa jamaa Marina Bay chapati. Si ndio wenye kusema. Si ndio controllers. For a controlling interest of 80% in Marina Bay company's equity, when the retained earnings of Marina Bay company were $25,000. The summarized statements of financial position as at 31st December 2022 are as follows, or 2012 are as follows. So we have Singapore and Marina. So remember, we own 80% of Marina Bay. So we are the controllers here. We are the parent. So in short, these two balance sheets must be put together. They must be put together. So I'll be showing you a shortcut of doing this, as well as BDA students, we must be good with shortcuts. We must be good with shortcuts. Otherwise, you will get yourself into trouble. But for today, I'll have to go through the long way, because I'm introducing the whole thing. Ladies and gentlemen, I'm so sure most of us here are lovers of animals. How many of us have ever been to Masai Mara? How many of us have ever been to Masai Mara here? How many of us? I just want to know whether you have been to Masai. I'll not ask you how you got there. I just want to know how many of us, out of, like now here we have 230 students. How many of us, at least Dama has been there? Ken Kim has been there. Linda Akinyi has been there. Ochieng, Naishi Mara, great. You need to invite me. Virtually, please, I never asked. I want people who have been there physically. Lucy, thank you so much. So in this case here, is there somebody who is able to remember the big 5 animals? Na hapo siku kama Gachagua mwenye ajui tofauti ya chui na gani anashindwa chui na ingine. Kuna mmoja anatoa machozi sana. Kuna mmoja anatoa machozi sana. Ufai kusahau hizo. All right. The big 5. The big 5. Tiger and leopard. The big 5. The big 5. So the big 5 animals ni gani? The big 5 animals ni gani? I forgot in this case here to write here that this is BDA from RCM Online College. BDA from RCM. If anybody wants to join us, they need to call us like today. This is our number. If you want to join us, any inquiries, you direct all inquiries there. Direct all inquiries there. All right. Gazelle, Beatrice, my daughter. Gazelle cannot be among the big 5, Beatrice. Beatrice, for getting it very wrong, I'm going to send you 500 Kenya shillings for getting it very. Gazelle cannot be among the big 5. 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 I would want actually, if I had money, enough money today, I would have made sure that this lady goes to Masai Mara or even here, Nairobi National Park. I'm so sure there will be some history. People will be able to tell her, these are the big 5. Ladies and gentlemen, one of those biggest, the king of the jungle is known as the lion. In our statement of financial position, we also have what we call the big 5. And this big 5, the first one is the lion. The first one is the group structure. If you get it wrong here, you get it wrong 100% in the entire question. So the first working we shall do is group structure. Group structure. So group structure, here we have a company called Singapore that has acquired, in this case here, Marina Bay has acquired 80% of Marina Bay. So 80% is more than what here? Is more than 50%. 80% is more than 50%, meaning that Singapore is the parent. So Singapore here. So for your case, of course, you don't have to draw in the group structure. You simply tell us that Singapore has 80%. So Singapore owns 80%, owns 80%. So automatically Singapore is the parent. And then we must be having another party here called NCI, the non-controlling interest. So non-controlling interest has got what percentage here? Non-controlling interest has got what percentage here, somebody? 20%. So, and that is it. For your group structure, that is it. So if I were you, I would write here this Singapore owns in one cell and 80% in a different cell. The same case here, non-controlling interest in a different cell, 20% in a different, so that I can do mathematics with these numbers. Otherwise, if you write everything in one cell, then you'll not be able to do any mathematics with these numbers. I want to do some mathematics with these numbers as I progress. Can I have one of you sharing their screen to see how you have recorded this? Can I have one of you sharing their screen? I want to see how you have recorded this. Anybody should be able to share their screen. I just want to see how you have recorded this. Just title, group structure, right? And then you have, in this case here, Singapore owns 80% on its own cell. And then we have non-controlling interest 20%. Please share your screen. Don't fear anybody. Don't fear anybody. This paper does not want cowards. If you're a coward, please ask us. Yeah, we are recording, yes. Thanks, Kelvin. We are recording, yes. I want to see students who have been able to record just this group structure. Then we have Singapore 80%. And then we have non-controlling interest. This is from Calvin's, yes. Ah, great. Thank you very much. So I would rather you write 80%, 80%, put the percentage there. Or you say 0.8. Great. And then the 20% as well. All right. You know, I like people who are very, very here. People who are very, very creative. I mean, he has been able to do this in the form of columns. I love this. This is very good. Thank you so much. So in this case here, then what you could do, if I were you, I would have said Singapore. Under Singapore, you put Singapore into brackets, parent. Singapore in brackets, parent. Parent. And then instead of saying Marina, that one should have been NCI, non-controlling interest. Yes. Thank you so much. Thank you so much. All right. So then at least we have some knowledge regarding, in this case here, what is happening here. And then if you allow me, I will be able to move here with speed, ladies and gentlemen. And so this is the first big five. Group structure. If you miss on the group structure, it is a lion. It is the one that is roaring in the jungle. If you miss that, you give us something wrong. The entire question will be wrong. Now from there, number two, the second working is the working that we shall be able to use to value subsidiaries. So in this case, the evaluation of the subsidiary. Number two now is the elephant. The elephant in the house. Valuation of subsidiary. Valuation of subsidiary. Because this subsidiary, we're acquiring it. How do we acquire it without valuing it? So we need to value it. And to value it, we shall use the net assets approach. Use the net assets approach. Net assets approach. Use the net assets approach. And remember that net assets is equal to what here? To equity components. Net assets equals equity components. Net assets equals equity components. Equals equity components. So is there anybody from your financial reporting who is able to remember equity components? Please give me those examples of the equity components that you're able to remember. Equity components, equity components, equity components. So equity components, I'm able to see ordinary share capital, yes. So we have the share capital. I love this. That's number one, the share capital. I'll remind you here, we have the share premium. We have the share premium. Any other retained earnings? Thank you very much. We have retained earnings. Retained earnings. Then we have, in this case here, which other one are they able to remember? Fair value adjustments, yes. Fair value adjustments. Fair value adjustments, fair value adjustments. And of course, we have depreciation. Depreciation of fair value adjustment. Depreciation of fair value adjustment. Depreciation of fair value adjustment. And then, of course, we have those other nice things, like, for example, they're calling UPS, downstream, upstream. We shall come back to those, but these are the major ones. These are the major ones. Thanks, Dama. These are the major ones. These are the major ones. This question doesn't have even UPS. Okay. And then now remember these equity components, you shall be able to give them to us in two points in time. We have here, you'll give us the equity components at acquisition, and at reporting. At acquisition and at reporting. At acquisition and at reporting. Kuna watu ambao wamenyamaza sana. I'm wondering, are there guys who are multitasking? Do we have guys here, for example, who are in class and they're eating their dinner at the same time? Do we have that kind of a person here? They are in a class, like, you can see I'm really sweating. All right. And then you are eating your dinner now. Is there any person, any ninja who is doing that? Who is doing that? Annette is even cooking. We shall overcome. We shall overcome. Wengi sana ndio masaa ya kula. Now, what I'm wondering then, if you're eating right now and you're multitasking with other things, will you be able to put this data in Excel? Because I want you to be putting this data in Excel. Rice particles all over. We shall overcome. We shall overcome. We shall overcome. You are through with dinner as I'm teaching. CBC homework. All right, all right, all right, all right. Not possible. We have to do this. So you see, these equity components, we are mentioning them at acquisition and at reporting. Now, please, let's start with share capital. Let's start with share capital. Where is our share capital? Where is our share capital? Go to your equity section. In your equity section, you'll be able to see equity shares. So remember, the first column is for Singapore, is for the parent. The second column is the one that is for what year? Is the one that is for our subsidiary. So you can see equity shares, which of course is another term for share capital. For the subsidiary called Marina is 15,000. 15,000 Marina. Remember, here we are valuing the subsidiary. We are not valuing the parent here. So remember, for share capital is a nice thing. It doesn't keep on fluctuating. Share capital at acquisition for the subsidiary will be exactly the same as share capital at reporting. So it means that for our subsidiary, the share capital here at acquisition will be 15,000. And the share capital at reporting will be 15,000 as well. 15,000 as well. 15,000 as well. So let me know whether you guys have been able to write up to here. Share capital. Have we been able to write up to there in Excel? All right. We don't have share premium here. So we shall put 0 there and a 0 there. 0 there and 0 there. The one that I would want to see whether there is anybody who will be able to post it correctly, although today, for some reasons, I don't have money today. Is it the date? What is the date today? No, mshahara yangu imeisha hata. Mshahara yangu imeisha hata. We shall overcome. We shall overcome. But I know we have great bankers here like Maslena who can loan us something. Who can loan us something. Guys who have earned their salaries on the 26th, 27th. They can own us something, and then we give students who are really participating in our discussions here. Now, ladies and gentlemen, please listen. Retained earnings. Let me see whether we have students who will be able to know the retained earnings at acquisition. Is there somebody who will be knowing retained earnings at acquisition? Retained earnings at acquisition. No. Remember, Beatrice, here, what are we doing, Beatrice, here? We are valuing just the subsidiary. You cannot bring the language of parent, nothing. Here it is only subsidiary. Here it is only Marina Bay. Marina Bay, it is only subsidiary. We are not talking about parent, because what are we valuing here? Remember, we have been able to know who is the parent. Now we are in the second stage of valuing the subsidiary. So everything is about subsidiary. What I need to know is retained earnings at acquisition. On acquisition, we are told here. On acquisition, we are told here. On acquisition, we are told here. They have told us on acquisition here. You can see We bought this on 1st January 2021 for 90,000 for a controlling interest of 80% Marina Bay's company equity, when the retained earnings of Marina Bay at acquisition was 25,000. So retained earnings at acquisition here was 25,000 here. And then what about retained earnings of Marina Bay at reporting? Open its financial reports. Open its financial reports and you'll be able to read the retained earnings of Marina Bay at reporting. Retained earnings of Marina Bay at reporting. You see here retained earnings of Marina Bay at reporting 40,000, 40,000, 40,000, 40,000, 40,000, 40,000, like that. Then from there we ask ourselves, when we were acquiring this subsidiary, all right, did we call in a valuer who did any fair valuations? What we used to call in the old standard revaluations. So you go to the notes to the account to see whether there is any fair valuation exercise that was done, that was done, that was done. All right. So in this case here, we are right. We are right. So come here, come here, come here. So here, what do we have, ladies and gentlemen? We are looking at the notes to the accounts. So notes to the accounts, blah, 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 blah. That's note number 1. It's talking about NCI fair valuation. I'll come to that later. For consolidation purposes, at the date of acquisition, the fair value of non-depreciable land of Marina Bay Company exceeded its carrying value by 25,000. That is the only asset, land, whose value we are being told was higher. The fair value was higher than the book value by 25,000. For consolidation purposes, at the date of acquisition, the fair value of the non-depreciable land of Marina Bay Company exceeded its carrying value by 25,000. So, ladies and gentlemen, then this 25,000 is what we bring here. So under fair value adjustments at acquisition is 25,000. Is 25,000. Remember, fair value adjustment, just like share capital, doesn't fluctuate. Fair value adjustment at acquisition will be exactly equal to the fair value adjustment at reporting, exactly the same. So 25,000 here, 25,000 here. And then, ladies and gentlemen, these guys have told us something very nice, that this is non-depreciable land. So if it's non-depreciable land, no depreciation whatsoever. No depreciation whatsoever. So please come and add for us. Give me the total valuation at acquisition and the total valuation at reporting. Total valuation at acquisition and total valuation at reporting. Remember, you're doing your workings in Excel. Vanessa is asking, what does it mean at reporting, at the financial reports? You know, the examiner has given you financial reports. So the figures you get there is what we pick as reported figures. Reported figures. Thanks for asking that question. So 65 and 80,000. 65 and 80,000. So we have here 65,000. And then we have what we call 80,000, like that. Thank you so much. So now the question that I would want to pose to you, but before I pose that question to you, I would want to see whether there is any student who has been able to capture this data in Excel very nicely. Please, I'm cheating you that I don't have money. You know I have money. Of course, as usual, I'll always have money. If you're that kind of a student who is interactive, who is showing us their numbers at the end of the day, you will be a winner in my class. You'll be a winner in my class. You can see these students, I did not get to see their name here. Look at how they're even doing, this great work. Great work, great work. Ordinary share capital, retained earnings. You can see how they're even underlining. This is brilliant. What is the name of this person? I can't see the name of this person here. These are the students we should be able to reward. There's a strip, this one here written there that This meeting is being live streamed on Facebook, which is, this is Paul Macau, my friend. Yes, Paul Macau, my friend. Paul Macau, my friend. Thank you so much. Great work, great work, great work, great work, great work. Thank you so much. So and then I believe that everybody has done a good work. Can I select one ninja by force? They share their screen. You see the students who are not writing anything. Can I appoint one ninja by force? Do I have that permission? Do I have that permission to select one ninja here? And remember, if I call upon your name, you must share your screen. Can I select one ninja to share their screen? Now they're saying yes. Okay, great, great. Let me select one ninja here. Now I will start with a lady. I will start with a lady. I will start with a lady. One ninja that I would want to have their screen shared here. I have Elizabeth. Elizabeth, are you able to share your screen? Elizabeth, are you able to share your screen very fast? Elizabeth, thank you so much, Elizabeth. Please pull it down. That is a good job. Thank you so much. Now you can see already 5 ninjas have dropped. You know, it was 230 students in Zoom. Already 5 ninjas have ran away. Those are cowards. Those are cowards. Those are not ninjas. They're black ninjas, not good ninjas. Now from there, then I would want to look for a gentleman to see how they're doing this. And this gentleman that I would want to pick tonight, you can see, is called Jared. Jared. We only have one Jared here. So Jared, very fast, are you able to share your screen? I want to see what you're doing. I want to mark. It's my right as a teacher to mark. It's my right as a teacher to mark your work. It is my right as your teacher to mark your work. Jared, where are you? Please just communicate there. You can as well say pass. You can as well say pass. It's also your right to refuse. Kevin Masara, this smart guy. Kevin Masara, are you able to share your screen? Jared, not able. Thanks for responding. Kevin Masara. Kevin Masara, are you able to share your screen very fast? I just want to see. How do you have a class at the same time doing Excel? Thank you very much. That's a very good question. Remember, here, the students, Sharon, they are writing everything in Excel because you guys will be tested in Excel. Even Mwalimu should be using Excel throughout, but you see today, I just wanted to use this point or this session here to hammer down my points. Otherwise, I should be using Excel. But for the students, always they shall be using Excel. They shall be using Excel. Just to show you guys, Naomi, thank you very much. Naomi is a friend of mine. Naomi is sharing her screen. All right. Thank you very much, Naomi. Great. Now, let me ask you guys a question. How many people, of course, I'll not tell you to show your screen here, but how many people are able to use Excel? How many people are able to use Excel? To write these things in Excel, how many guys are able? Can put your hands up or you simply say yes, 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 yes. Sharon Amgongo. All right. I can see so many of you. You can see people are using Excel. You can see people using Merab, yes. You can see people are using Excel. Vitalis Okwiri, Linda, yes. So we are using Excel. So please don't take it as an excuse that Mwalimu is writing on the board. Oh, you're using your computer for? No. Sharon, you'll have to learn. You'll have to learn. You'll have to learn. You'll have to learn. It's something you'll have to learn. I suppose today is your first what year? is your first session. So perhaps in future, as you continue learning, you can have 2 laptops, one for practice. But I mean, even with one, myself, whenever I'm in meetings, I'm able to use, you can, for example, split screens, etc. In your discussion groups, you should be able to discuss those things. You should be able to discuss those things with your friends. All right. So then I go straight away, multitasking, great. Now, let me ask you a question. Is this subsidiary grow? If you look at the valuation here at acquisition and the valuation at reporting, we are growing. We are growing. We are becoming bigger. The value of the subsidiary with the time is increasing. Please give me the difference between this. In Excel, you simply go to a different cell and say equals. You say this minus this equals 80,000. You pick this minus this. You give me an answer. What answer are we getting there, my great students? What answer are we getting there, my great students? What answer are we getting there, my great students? We are getting a figure of 15,000, isn't it? So that 15,000 is what we call post-acquisition profits. So we have here post-acquisition profits. What shall be abbreviating as PAP? So PAP is 15,000. PAP is 15,000. Are we getting that 15,000, ladies and gentlemen? As PAP, 80,000 minus 65,000 is 15,000. I think there is a problem there. Somebody wants Damaris to swing in and help. Let me see. What is the problem? Irene Otieno Chioma rescue. Concurrently. So those are things that you guys can discuss in your discussion groups. You can discuss those things in your discussion groups, or even ask my assistants here like Omondi. He'll be able to show you guys how to do it. Because you need to work on your screen and at the same time work on what here? See as I teach. See as I teach. See as I teach. But again, if you're a real ninja, you should be able to do it kienyeji way and get things right. Now, ladies and gentlemen, this profit, growth in profit, is what we call post-acquisition profit, which should be shared out. Shared as follows. Shared as follows. Are you able to remember the parent company? So you say parent company. So parent company, of course, you can remember the 80%. If I were you, I would go to a different cell. I write parent, and then I go to a different cell, say equals. I go to where we have 80%, pick it. Times, I pick this 15,000. I can also do it the Kenyaji way. So I'll say parent equals, I know the parent has got 0.8 times 15,000. And then I say equals, or enter. Enter. What are we getting there? What are we getting there, my great students? $12,000. I mean, without, the scientific ways to pick those numbers from wherever, so they're going to create what we call a financial model. So that in the future, should someone tell you, what if, for example, you acquired 75% of Marina? So you don't have to keep on repeating the entire Excel. No, you simply go and change the percent. And then every other thing is now automated. But for us, we can always keep on saying like equals, you pick this 0.8 times 15,000. So I'm being told that this parent will take home 12,000. And then of course, we know that there is another owner known as the NCI. So NCI in this case here will take 20%. So 0.2 times 15,000, which will end up giving me what figures, and gentlemen? Which will end up giving me what figures, and gentlemen? 3,000, like that. 3,000, like that. All right. So what we shall do is to stretch for 5 minutes. I think a break is necessary. Oh, we forgot. I mean, we can't take a break right now. Do you think it's necessary, really? We should have taken a break at exactly 9. At exactly 9. Now it's almost 9:30. I make a request here. I just continue, and then we just break earlier. We break earlier. We continue. Yes, I think so. Now, ladies and gentlemen, the next thing, after you have been able to come up with this, the next thing will be for you to come and give us what we call will be for you to come and give us what we call goodwill. So come here and give us goodwill. So remember, this is the third working. Goodwill is the premium that we pay on acquiring a subsidiary. The premium we pay on acquiring a subsidiary. The premium that we pay on acquiring a subsidiary. How do we calculate it? There are two methods. Two methods. The first method is what we call full goodwill. Full goodwill method. Full goodwill method. Full goodwill method. We use this used when NCI value at acquisition is given. Use it whenever NCI value at acquisition is given. Like in this case, if you look at note number 1, they have given us the value of NCI at acquisition. Yes, they have given us that value. So whenever the value of the NCI at acquisition is given, then remember very fast that they want you to use full method. So today I'll only look at this full method, but of course, as we progress, we shall be able to get other questions where this NCI at acquisition value is not given. And if it's not given, then we shall be able to use what we call partial method. Here we are working on full method. And this full method is very, very easy. It's very easy. The format is like this. You simply take, in this case here, the consideration paid by the parent. Consideration paid by parent company. And then we have, in this case here, consideration paid by NCI. You add the two to get total consideration. To get total consideration. So you add the two to get goodwill, you'll come under less, in this case here, net assets at acquisition. Net assets at acquisition to get goodwill here. To get goodwill at acquisition. To get goodwill at acquisition, which later on we shall be impairing to get goodwill at reporting. Here, it's a simple example. There was no impaired goodwill. There was no impaired goodwill. There was no impaired goodwill. Kuna kuanga na discussions? Yes. I think for discussion groups, we should have just one discussion group. We should have one discussion group for the morning students and the evening students. One discussion group for the morning students and the evening students. And of course, we should also give students liberty. If you want to do like a weekend only discussion, then you can also be allowed to do the weekend discussion. And then we should be able to give you guys a Zoom link. We should be able to give you guys a Zoom link that you shall be able to use to do what you're to for discussions. Because what I know, BDA without discussions, trust you me, you're not going anywhere. That one I can bet with you 100%, regardless of how smart. You know, there are students who come to this BDA, they have never failed at all these other papers. They were passing one touch. They were great ninjas. One kick, snap down. Another kick on another paper, snap down. But for BDA, I've seen students failing 4 times. And these are not students who are not very good. They are very brilliant students who are failing how many times? 4 times. So in this case, a discussion is not something that you debate about. You must be a member of discussions. Now moving forward, we shall be meeting 4 times, remember, because now we have started being serious from today. So we'll be meeting 4 times, early morning students and evening students, 4 times. So if you're meeting 4 times, you guys must also have 4 discussion meetings in a week. because you must try to mirror everything that you're doing in class, if not doing more. You should be able to do more. You should be able to do more. You should be able to do more. So that is why it's an exit paper. It's an exit paper for CASNEP. You do it as a single paper, and if you're not careful, this exit paper may refuse with you in the system. All right? So we have to be very, very careful. We have to be keen on the discussion groups, etc. etc. We shall overcome. That is the most important thing. We shall overcome. What time, which days? Good questions. I think those questions we should be able to do what here. We should be able to discuss them in our paid WhatsApp groups. Please, I hope, Damaris, you're giving out your number there. Don't add anybody from outside. We also need RCM to get revenue. These discussions are discussions for what here? For our students alone. I hope I've been able to communicate that, Damaris, very well. Don't bring people from outside. Nobody should, twist you to add them to the group. Be very, very, because it's a business model that we have. All right, so then come here, ladies and gentlemen, and straight away help us calculate this goodwill. Help us calculate this goodwill. Help us calculate this goodwill. So, do we have the consideration that was paid by the parent company? Do we have the consideration that was paid by the parent company? The parent company, we are told here, on 1st January 2011, Singapore company paid 90,000 for a controlling interest of 80% in Marina Bay. So we paid 90,000. Yes. So consideration paid by the parent. Parent is Singapore. Consideration paid by parent, in this case here, is 90,000. And then we have consider, because it's full method, consideration paid by this other party called non-controlling interest. So do we have this? Remember, this will be fair value of NCI at acquisition. Fair value of NCI at acquisition. Fair value of NCI at acquisition. So you can see Jared there saying, please add me Madame Damar. Now Damaris has become a Madame. Yeah, please, before you add them, please ensure that they are in the paid group. That's the most important thing. Please don't take that for granted, please. Please, we want these students to pay us. All right, so you're being told in this case that NCI from note number 1, at the date of acquisition, the fair value of the NCI of Marina Bay Company was measured at 20,000. So this was measured at 20,000. So in this case here, fair value of NCI was 20,000. So the total consideration is 110,000. So this is the total consideration. Total consideration is 110,000. Then you will come and less net assets. Less net assets at, are you able to see the net assets at acquisition? Is there anybody who is able to see that 65,000 from working number 2? Is there anybody who is able to see the 65,000 from working number 2 at the date of acquisition? Yes. 65,000 at the date of acquisition. At the date of acquisition, 65,000. So you take 110,000 minus 65,000. What are we getting here, somebody? What are we getting here, somebody? 110,000 minus, so it's 45,000. This is the goodwill. This is the goodwill. Just write it there, goodwill. Goodwill, goodwill, like that. This is goodwill, 45,000. 45,000. So I would want you guys now to do me a favor. This is working number 3. Working number 4 is the easiest. It is NCI at reporting. I would want somebody to do NCI at reporting. NCI at reporting. NCI at reporting. Already Paul Macau has an answer. NCI at reporting. So can I rub this? Can I rub this? Can I rub this? Yes. Do you put workings on the solution? Yes, yes, yes. You see now these are workings, and then down there, you're going to have like our group, a statement of financial position. Everything is there. Everything will be able to give you marks. Able to give you marks. All right. So I can see, ladies and gentlemen, they're telling me, Mwalimu, rub this very fast, and then you go and give us, go and give us, go and give us, go and give us, go and give us the NCI. So working number 4, NCI at reporting. So NCI at reporting, what do we have? We have NCI at acquisition. We have NCI at acquisition that you guys have given me a figure of 20,000. But now remember, we have share of PAP. We have share of PAP. Is there somebody who is able to remember NCI's share of PAP? Is there anybody who is able to remember NCI's share of PAP? These guys are tired now. They're tired now. So it is 3,000, isn't it? It is 3,000. So this is 23,000. So this is NCI at reporting. NCI at reporting. NCI at reporting is 23,000. So up to there, are we really together? Up to there, are we really together? Up to here, abracadabra. Guys are not talking to me. Abracadabra, abracadabra. Ladies and gentlemen, the last working to be able to finish with our big 5 is what we call group retained earnings. Group retained earnings. Group retained earnings. Not many students will be able to give us the group retained earnings at reporting. Group retained earnings at reporting. Group retained earnings at reporting. Not many students will be able to give us the group retained earnings at reporting. Not many students will be able to give us the group's retained earnings we shall overcome. Very easy. That is the easiest amongst them all. Yes, it is 112,000. It's 112,000. So the group's retained earnings is here. Remember, group retained earnings, we simply have 2 things. We only have 2 things here. So the group retained earnings, what do we have there? The group retained earnings, what do we have there? You can see we shall pick the figure of the parent. So the parent's retained earnings. So working number 5, group retained earnings. So we have here the parents retained earnings. Those 100% they belong to the group. So the parents retained earnings are 100,000. And then of course from the subsidiaries, we can only talk of our share. So you can see the retained earnings for the group, for the parent, 100,000 here. And then, ladies and gentlemen, we can only come here and talk about our parent share. The parent share of PAP, which if I remember very well was 12,000. So then this gives us 112,000. This gives us 112,000. So is that correct? Is that correct? Are we together up to here really? Are we together up to here? Are we together up to here? So now we are through with the big 5. Big 5. Remember, in an exam situation, I'll not tell you to take this approach. I'm telling you to take this approach because now I'm just introducing the thing. But otherwise, there are very many shortcuts which I'll be able to share with you. Now, once you have done that, so we go to the last step now, which is the group statement of 40-year financial position. We call it the consolidated statement of financial position. Consolidated statement of financial position. Statement of financial position. So consolidated statement of financial position as that, I know those things you guys are very good at them. So then we come here and look at assets. So, and remember, under assets, you must always begin with non-current assets. So non-current assets, what do we have? And we have to move now with speed. And current assets, we shall be able to finish here in less than 10 minutes. So non-current assets, what do we have here? So non-current assets, what do we have here, ladies and gentlemen? So non-current assets, ladies and gentlemen, what we have here under non-current assets, we have here investment in Marina Bay Company. Now, ladies and gentlemen, let me ask you a question. Who is Marina Bay to us? Can we really put down this investment in our books? Remember, Marina Bay is our subsidiary. Subsidiary is part of us. If you invest in yourself, you can't put that investment in your books of accounts. If it is an investment in associated, that is good, because that is a distant relative, like a cousin. That investment, I have to account for it because I expect a direct return. But if I'm investing in myself, ladies and gentlemen, the only thing that I can do whenever I invest in myself is to account for the goodwill, which comes as a result of investing in myself. Goodwill. So an investment in subsidiary will always be replaced with what we call goodwill. So in this case here, we have goodwill. And remember, there was no impairment. So goodwill is 45,000. So investment in subsidiaries will always be replaced with goodwill. And ladies and gentlemen, these are some of the things that bring issues even in marriages. If you invest, for example, in your wife's academia, you've paid, in this case here, for example, 500,000 for your madam to do masters. Should you put that figure in your books and then you keep on reminding her that, you know, if it weren't for me, you would, in this case here, be wallowing in poverty? Do you think that is a better way to go, men who are in the house? Because, I mean, we are told in the Bible that you and your wife are one thing. So if you invest in her, I mean, you can't really put that in your books. The only thing that will happen is that the two of you will start enjoying what your goodwill will be there. So investment in yourselves in subsidiaries will never be put in any books of accounts. Don't put that in your heart. And the same is applicable to women, for example, who sponsor their husbands over some petty things here and there. And then you keep on reminding your husband, even in front of that, do you know that shirt? I'm the one who bought it. Takwambia we niki. Mimi na wewe ni kitu moja. So kama umenunua shati hii, wengine wakisema, so we can only enjoy goodwill. Niki. All right. Other socks. We shall overcome. We shall not be reminding people. Oh, nimekutacha. No, don't worry. We shall not be reminding our better halves. All right. So you follow this. Then we have our property, plant, and equipment. So property, plant, and equipment, we shall take 30,000 plus 30,000. We are consolidating, remember. And current assets, 30,000 plus 30,000. But there is something that normally happens here. So we have our PPE. The parent company, 30,000. We have the subsidiary, 30,000 you're adding. Plus, do you remember any fair value adjustment of a property item? What was the amount, that fair value adjustment? Are you able to remember that fair value adjustment? What was the amount? No, they are not following these guys. They're not following these guys. 25,000, isn't it? 25,000. Unfortunately, There was no any depreciation. So kindly give me the new consolidated property, plant, and equipment figure. Consolidated property, plant, and equipment figure. PPE, 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 PPE. From Wanjiko, 85,000, like that. All right, and then we have our current assets. We have our current assets. So remember, we are consolidating, we are putting things together, we are adding things together. Consolidated statement of financial, this stands for statement of financial position. So please go and pick the current assets, add them, put them together. So current assets, I can see 30,000 and 30,000, put them together. So 30,000. So for current assets, you need to ask yourselves whether there is any short-term inter-owings between the parent and the subsidiary, between the parent and the subsidiary, between the parent and the subsidiary. So current assets, just look at the notes of the accounts, there will always be inter-owings. We are told here, at the reporting date, Singapore company is owed 5,000 by Marina Bay Company. Now, ladies and gentlemen, please, let's be very, very honest between this. And this is a very serious thing, very serious thing. My wife and I, of course, we are taking ourselves as what here? One entity. So if, for example, in the morning, this great lady tells me, Mwalimu, and up to date, she calls me Mwalimu. I've never understood why. Perhaps she sees me every day teaching. Mwalimu, give me 100,000. So when I give her 100,000 payable in 3 months' time, payable in less than a year, then honestly speaking, I should be able to book this as a current asset. But now let's be very honest with each other. Do you think I will ever receive this money? Given our relationship, do you think I'll ever receive this money back? Any internal owings between the parent and its subsidiaries, those internal owings are fake and they shall always be eliminated from your assets because you shall never realize them. So if Marina Bay, in this case here, owes something to Singapore, that inter-owing, one company is accounting for it as an asset, the other guy is accounting for it as a liability. So we need to cancel them from the two ways. So in this case, ladies and gentlemen, these current assets, they're overstated. In this case here, come and subtract like that. So in this case here, 30,000 plus 30,000, 60,000 minus 5,000. So we have 55,000. So is there somebody who is able to give me the total assets here? Is there anybody who is able to give me their total assets? You can see all these guys saying that the money will be returned back. Those guys must be the young thugs in the room, the guys who are not married. But people who are very married here, they'll tell you, if this money, assuming it is Mwalimu who was to borrow from his wife, if Mwalimu here, I borrowed 100,000 from my wife, anybody who is married here, if they were very honest, they'll tell you that ikiwa ni ya bwana ameomba, ikiwa ni bwana ameomba, hatarudisha. Hiyo lazima irudi. Ikiwa ni bwana ameomba, lazima irudi. Sisters who are here, who are married, true or false, be very honest. Be very honest, at least for once. It's from Chama. This lady is married. Na interest here. Selina, mimi nasema ukweli. Wow, Frederick Wekesa, just take the money. It is yours. We have Geda Swale. False, okay? Then I could be wrong, but trust you me, for most ladies, 100% of the ladies, whatever money they give you, you have to return. You must return. 185,000. These are the assets. Then let's see whether we shall be able to finance this fully. So mention there, equity and liabilities. So the financing aspect, my board is quite tiny. If it was quite lengthy, I would have preferred to write everything here, but that 185,000 figure shall be remembered. So we have here equity and liabilities. So we begin with equity. Equity, so we have share capital. Share capital in consolidation, you shall only take share capital of the parent only. The same case with share premium, parent only. So are you able to see the share capital of the parent only? Are you able to see the share capital of the parent only? Share capital of the parent only. It's here. It's here. Parent only, share capital. 25,000, isn't it? 25,000. Thank you so much. 25,000. Share premium, nothing. So we have retained earnings. Retained earnings, there is a calculation that you guys did. There's a calculation done up there, working something. Are you able to remember that figure? I remember it was 112,000. Remember under equity, so many students will always forget this. Under equity, we have some permanent source of capital. We have some other colleagues who have partnered with us, who have made some contribution. They are called NCI. NCI. So NCI, is there anybody who is able to remember what NCI's figure was? NCI, I can't remember very well. NCI always is part of permanent source of capital. These guys will never come back for their money. 3,000, 23,000. NCI was 23,000. NCI. Remember NCI, Beatrice, we took NCI at acquisition and then NCI share of PUP. So this gives us 23,000. And then now we look at the liabilities. So liabilities start with long term. Share capital nimetoa wapi, Irene? Ndio hii hapa, share capital of the parent only. This question here, it has equity shares. Equity shares is the same as share capital for the parent only. Don't add the two. Don't add the two. Okay, so from there, ladies and gentlemen, come and look at the liabilities. So liabilities, we only have these liabilities called liabilities there. So liabilities, we have 25,000 plus 5,000. But is there somebody who remembers that there is a fake liability here? Is there anybody who is able to remind us what we're supposed to subtract here? Anybody who is able to remind us what we're supposed to subtract? Yeah, because this internal owing, one company takes this as a receivable, as an asset. The other company takes it as a payable, as a liability. So in this case, that's a fake liability. Subtract 5,000. So then come and give us here 25,000. And if you account for this very well, then the total equity and liabilities should be equal to 185,000. Total equity and liabilities. Total equity and liabilities. Total equity and liabilities should be equal to 185,000. Is it balancing? Is our thing balancing really? They are saying it's balancing. I wish I were you. I would have woken up wherever I am and danced crazily. Until my kids think that I'm crazy. It's called eureka moment, when you discover new things. You need to know how to celebrate your milestones. You need to know how to celebrate your milestones. So again, I would want to see how my students were. I don't understand that 5,000. I'll be able to explain. I'll be able to explain. All right. So this 5,000 is this one here. Here. At the reporting date, Singapore, who is the parent, owed 5,000, is owed 5,000 by Marina Bay Company. And Marina Bay is a subsidiary. And we're saying that parent and subsidiaries should never be having any inter-owings. Never. Never be having any inter-owings. If they tell you that they are internal owings, then you need to go there and subtract from the current assets and subtract from the current liabilities. Is that okay now? Is that okay now? Is that okay now? All right. All right. So, ladies and gentlemen, we've come to the end of this session. But just before I close, is there somebody who can share the Excel? We see how they've been able to capture this in Excel, because it's a BDA class, Excel. We want to see how they've been able to capture this. See what this guy is doing. Paul Macau, great job. Balancing nicely. Great job. See even the workings, everything. Thank you, Paul. Let's get to see what other students have. Damaris, great. Thank you very much. Great. Damaris, that's very good. Very good. What about the other students here? Ken Kim, Elias Mugendi, that's very wonderful. I mean, at RCM Online College, I have great students around here. Great work. Thank you very much. We have Beth. So there is somebody who wants Damaris to switch on her camera. I think the very best would be all of us to switch on our cameras. Yeah, Moni, thank you very much. I can see your work there. Instead of just targeting one student, let's, in this case here, all of us get to switch on our cameras. Yeah, today is the D-Day. Thanks, Ken Kim. That's great. Now we have entered into another session where we would, thank you, Kim, want to see our fellow students here. Where are they? Why am I not seeing anybody? I mean, putting on their cameras, honestly. Yeah. Most of them are fearing, right? So now you know this student wanted to see now one student only. She can't put on her camera. And you can see now these students want us to have like one special day where we'll be able to dress up nicely, put on very good makeups, and then we will be able to appear on camera. For today, just excuse us. You shall not even be able to see Damaris. And Damaris, thank you very much. Of course, I'm so sure people would want to place a face to this great lady who is getting out of her way to assist other students. Nothing more, nothing less. Because I'm not a believer of having an accountant marrying an accountant. No, it's because these people would want to see this kind of a great-hearted lady who is willing to do what to help us. But that we shall be able to see that later. So for today, bye-bye. Thank you so much. All the best. To be blessed. Bye. The part of retained earnings. Somebody is asking the part of retained earnings. Mercy, what do you want to know about the part of retained earnings? There is a working, Mercy, we are done. On retained earnings. If you remember, where we took the parents, we took here the parent share. 100,000, plus that share of post-acquisition profit of 12,000. That's how we came up with the 112,000. We're done this working among those big five. Please make reference. Thanks, Beatrice. At least you are sharing there. All right. Bye. Thank you so much. Good night to everybody. Say hi to your family members. Of course, they get to see me every day. Yeah, God bless you as well, Damaris. Good night. Bye. Tomorrow keep time. Great. That's very good, Mas. At least now your children, they know Mwalimu. Thank you. Wonderful session. Thanks, Eric. We shall overcome. Bye.